Okay, good morning, everyone, and welcome to this morning's edition of the Coffee Microcaps Morning Meeting. My name is Mark Tobin. I'm the founder of Coffee Microcaps. For anybody who's joining us for the first time this morning, and for all our regular attendees, welcome back to this morning's event, a day early. Doing it on a Wednesday rather than a Thursday, but we still have 3 good presentations coming up over the next hour and a half. I'd like to give a special mention to DMX Asset Management, our sponsor of all our virtual events here at Coffee Microcaps. If you're looking for a small cap or microcap fund manager, please check out their website for the relevant PDS and financial services guide, or indeed just reach out to Stephen or Michael at DMX. Quick compliance and disclaimer slide. For anybody who is joining us for the first time this morning, the companies we generally have presenting on here on a weekly basis are capped under 300 million, are in revenue and approaching cash flow break even, or in the case of some of our presenters this morning, are indeed already profitable. We generally don't have companies from the resources or biotech sectors, so what I like to call industrial microcaps, which covers everything from microcap technology, healthcare, financial services, consumer goods companies, and that basically all the other sectors you would be familiar with. Structured this morning's webinar, and we generally have 2 companies. We've got 3 this morning. Each will get a 30-minute presentation slot, which we break down into kind of 20-minute preso and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate to our presenters. And please note the webinar is being recorded and it'll be posted on the Coffee Microcaps YouTube channel next Monday. I'm only going to put up Monday given the holidays and day of commemoration tomorrow. You can follow us pretty much on all the social channels, Twitter, YouTube for the recording of this, and indeed all our previous events. We've got well over 100 company presentations on there now, and I write a free monthly newsletter which you can get on the Substack newsletter platform. Up first, we've got Simon Morris returning from Genetic Technologies to give us an update on everything at GTG. Then we've got another returning presenter, Steve Boland from Acrow Formwork. And then finally, a returning company, but with a new CEO, we've got Scott Basham from Xtek. So that's enough from me. I'm going to stop sharing my screen. And Simon, if you want to start sharing yours. I'll let you know. It's coming through now. Yeah, I can see the cover slide of your presentation now, Simon.
Fantastic. Can you hear me okay there, Mark?
Yeah, audio sounds good.
Fantastic. Well, thanks for having me back, and really thrilled to be able to share the progress that the team has made over the last 12 months and probably earlier in the year when we first caught up together. Just similar to yourself, Mark, a compliance statement, forward-looking statements that everything that we do share in this presentation is our best management and executive insights. And as everybody knows, things can change from time to time. Over the course of the next 20 minutes, I really want to take a moment to share the vision and the world-leading portfolio that the team has developed over the course of the 12 months, focus on the market opportunity, focus on our global presence, focusing on our pathways to market, some of the key operating insights, and the patented innovation and the divisions that we have as part of Genetic Technologies. And for those of you who are new, welcome, and I hope you enjoy this story of our business and our brands. And if you have any questions at the end, you can certainly get in touch via Mark or via our socials as well. Our business, Genetic Technologies, is all about unlocking personalized preventative medicine, and we have a comprehensive guideline-driven portfolio transforming the conversation from a one-size-fits-all model to a personalized preventative health model where individuals, patients, and physicians have the information to identify a proactive pathway for preventative health based on your individual risk of serious disease before onset. We have a world-leading guideline-driven portfolio led by our patented geneType multi-risk test, which identifies risk for individuals of serious disease before onset, and I'll talk more about the diseases that we cover, but the test itself is a single non-invasive saliva-based test with a series of clinical risk questions, polygenic-based, that covers up to 70% of mortalities and morbidities annually. It's a really exciting innovation for the team. Non-invasive prenatal testing, carrier screening, pharmacogenomics, oncogenetic, and even animal care. Our revenues are anchored in 3 key brands: geneType, which is for serious disease and oncology, cardiovascular and metabolic diseases; our EasyDNA brand and our AffinityDNA brands, which are on the direct-to-consumer portfolio. I talked a little bit about the patented integrated risk tests for a range of clinical conditions. We have 25 patents that protect the geneType tests for individuals. When I say integrated, this integrates familial, clinical, and genetic information to give an individual their risk and actionable insights to start a preventative pathway to catch disease before onset. What drives us at geneType, what drives the brand, what underpins the values of the brand is these values here: an unequaled experience and the scientific team leveraging their extensive research and network and their knowledge and their collaborations to build best-in-class products. That relentless pursuit of innovation, that leading integrated technology, which is protected by 25 patents worldwide and setting new clinical and safety and ethical standards worldwide. A snapshot of our business as it stands today, we have about 57 employees globally. We're actually domiciled in 5 offices around the world, but we have presence in 40 countries. We have 25 patents that protect our brands. We have 14 test categories and 51 tests that we offer. And importantly, we have 12 partnership laboratories scattered around the world and led by our CLIA and NATA certified high complexity lab here in Melbourne, in Fitzroy, in Australia, which services a number of our leading patented technologies. A couple of operating insights, which is taking us to the June quarter of FY22, recently published in our annual report, and then our annual results here as well, and some of the highlights here. We hit $2 million for the revenue for the quarter, $6.8 million for the year, and up substantially on the prior year. Gross margin at around 51% or $1 million, and cash at the bank at the end of June 2022 there was $11.7 million. A couple of highlights from our perspective was that we've delivered 4 consecutive quarters of growth on the prior year, and we are on track to deliver a 5th consecutive quarter of growth on the prior year. One thing I'll talk a little bit more about in a moment is one thing that is key for material revenues for us going forward in the future, and it's the completion of a budget impact model independently developed for health and economic benefits for the B2B channel in the United States. In this particular example that I'm going to talk about today, it unlocked a saving for the US payers in B2B channel of 3.6% of the screening costs and treatment costs of breast cancer alone, equivalent to $1.4 billion, which is extremely exciting from our perspective. We've initiated conversations with payers in the US. We have a target list of 30. We've got active conversations with 11, and we're progressing very well with 4 right now. The geneType multi-risk test in Australia is also gathering momentum, and we're now at 24 at that count at the point in time, but now up to 54 clinics where their test is being implemented in their locally primary care physicians. Our EasyDNA market expansion into Europe, our EasyDNA expansion into India, and then the successful ARTG launch of our multi-test on the diseases that I'm going to share about in a moment. Key to the success of our business going forward is focus. We have 4 core focus areas here. One is to execute the B2B commercialization strategy of the geneType multi-risk test, critical in driving revenues for us in the next 3, 6, and 12 months. And I'll talk a little bit more about that in a moment. Second, which underpins that, is demonstration of clinical validity and utility of the geneType tests, getting peer-reviewed publications that support all of the science and the innovation that our team have developed over the course of many, many years. Driving revenue and growth in the EasyDNA direct-to-consumer channel and AffinityDNA with new tests, new channels and new markets, and the launch of the new e-commerce site coming up in the coming month. Innovation is also the key for the life of our business here, and we're going to be starting with the next generation of innovation, starting with epigenetics. If I take a moment to just look at the market size and the opportunity for us that we're facing into and that we're focusing on seizing, I've broken this down into two particular areas. One is the predictive genomics piece, one that has a $1.3 billion growth opportunity ahead of us. The second is the direct-to-consumer piece, which has a $1.4 billion growth opportunity to us. Both of those two channels are really important for us for the success and the material revenue generation of our business going forward. And we're focusing on the near term, which is the B2B channel, which is the predictive genomics and the payer model, but also notwithstanding the fact that there is a massive opportunity with our direct-to-consumer business with EasyDNA and AffinityDNA, and then including the pet care, which is a substantial market worldwide. I talked a little bit about our innovation just before, the multi-risk test, which is clinically integrated with familial, clinical, and genetic risk factors. This is a polygenic-based risk assessment test with clinical risk factors, which provides individual risk and actionable outcomes for patients to detect disease before its onset. In phase 1, we've already launched the first 6, which are in the teal color there. It's in breast cancer, colorectal cancer, prostate cancer, ovarian, coronary artery disease, and type 2 diabetes. We have 3 more, which are in the final stages of development, and then subject to regulatory approval, they will be released towards the back end of this calendar year. This is, as I mentioned before, a non-invasive, simple saliva collection device with a series of clinical questions with consent given to you by your doctor, and the results go back to your doctor, and then you can start a proactive pathway to monitoring and surveillance of your health to make sure that you catch disease before onset. I also mentioned earlier that these 9 tests on this particular multi-test will cover up to 70% of mortalities or morbidities annually, which is really, really important worldwide. The budget impact model, which I referred to on one of the slides earlier, is a really compelling piece of information that has been independently developed and validated by a team in Boston called Alva 10. They are a specialist market access team working very closely with the payer community and the insurers in the United States. This particular model that I'd actually like to take a few moments to talk you through around the savings that this model has independently validated for breast cancer treatment annually is substantial and material, and has opened up a number of doors for us for a lot of active conversations in the United States. The model shows that there is a saving per payer, per person, per year of $73, which doesn't sound like a lot. What this model also does, it actually shows that we are going to add cost to the system by screening more women from 69% to 74%. Once we identify that risk of one of 4 different pathways, we're also going to add more cost to the system by supplemental screening frequency from 6.8% to 9.2%. What that delivers for us is a drop by 40% from 14.8 to 8.8% in the interval cancers. We detect early stage cancer more often and higher frequency from 57% to 67%. And as you all know, that the earlier detection of cancer, the higher the survival rate, and then therefore also the lower the cost to treat. So therefore the summary of all of those key inputs there from the payer system from the United States is that there is a total of 3.6% saving to the payer system for the screening of breast cancer, which is equivalent to $1.4 billion, which is extremely exciting for us, which is, as I said, opened up an incredible amount of doors for us in the United States with the payer community. I'll talk about some of those active conversations we've got at the moment. Some of the divisions of operations that we've got is oncology, cardiovascular disease, serious disease and COVID-19 risk, metabolic diseases with diabetes, the lifestyle, ancestry, microbiome. Those ones in blue are the ones that we do and specialize on in-house. And as I mentioned before, we have a series of partnership laboratories around the world that actually help us bring this comprehensive guideline-driven portfolio to the market of pharmacogenomics, germline testing, so BRCA and Lynch syndrome, and carrier testing, NIPT testing. We have a suite of tests that go worldwide and that these laboratories actually help us with. The pathways to market are distinct, and there are three. The one that we are focusing on most heavily with the geneType brand is the medical and the payer B2B pathway for all of our tests on the multi-risk test, which I just shared. We have a consumer-initiated testing platform where a consumer can go and initiate the test, to order the test, and then therefore they give us their doctor's details, and the medical supervision is required when the reports go back to the doctor, because we can't just give away potentially high-risk results to a patient without that medical supervision. The third channel is our exciting direct-to-consumer testing business, which is EasyDNA and AffinityDNA, which looks at tests like ancestry, paternity, health wellbeing, pharmacogenomics, and a number of other testing there, including DNA storage. Specifically looking a bit deeper into the pathways of B2B, we have a payer-driven model here where we're focusing on, in the United States, plus concierge medicine, plus functional medicine, and independent doctor networks. They are the key four aspects of the payer community in the United States. In Australia, we have two partnerships we're focusing on here, is the primary care physician or the GP practices here. We've onboarded 54 of those now in Australia. And then from there, we've also got a partnership with Associate Professor Charles Siles, who owns Siles Healthcare, who has 9 clinics, 15,000 patients per annum, and has 1,000 referring doctors to him in his network. So we are working very, very closely with him in bringing that multi-test, especially with breast cancer and ovarian cancer, to market. I mentioned earlier some of the magnitude of some of these US payers. 3 of them, as an example, where active conversations are being had at the moment, the likes of Humana, Aetna, and Blue Cross Blue Shield. So, and we've also got some smaller payers, such as the Kentucky Retired Teachers Union, for example, which are really exciting for us as well. The other 2 channels at the moment also, which is the consumer initiated and direct to consumer, wanted to make sure that we still showcase those a little bit, but the most important one to us is that B2B channel. It's the most material revenue generation for us in the short to medium term, in the 3, 6, and 12 months, and something that we're really excited about, which is underpinned and foundationed by the budget impact model developed by Alva 10. Growth strategy for EasyDNA. We've done a brand refresh already to modernize the look and the feel of the brand. We're probably about 80% of the new website refresh, and we have to do this in multiple languages because it's in 40 different countries. That's for mobile and for desktop versions as well, and that's being powered by WooCommerce. So we're really excited by that coming to market very soon. That'll actually improve then phase 2 of the growth, which is improved lead generation, Google ads, Facebook ads, retargeting, remarketing, etc. And then the next stage is Amazon stores and the footprint there, target new B2B customers and target new markets. A couple of big markets that we've talked about earlier is the likes of India. All of our test categories are live, and you can see these on our website, genetype.com, and you can click through each of those logos to go through to each of those different websites if you're interested in that and having a look at them. What I wanted to just finish on was this particular slide here, which is just highlighting some of the achievements from the team over the last 12 months. We've launched the phase 1 commercial release of the geneType multi-risk test. We've got now, as I say, 54, not 24, medical practitioners onboarding a test here in Australia. We've completed 2 acquisitions with EasyDNA and AffinityDNA in 11 months, and really proud of the fact that Dr. Erica Spaeth, who is our Director of Clinical Affairs based in the United States in Houston, is being invited to present at these very prestigious conferences in the US about our tests and about our technology. One of the videos on our LinkedIn page, you'll also find a fireside chat with Erica and Hannah Mamuska from Alva 10 on Beyond BRCA and the implementation of our test from the Precision Medicine Leaders Summit at the Broad Institute in the United States in Boston earlier this year. As I mentioned, the acquisitions of EasyDNA has been completed. My apologies. They're about to do a test of the fire drill here. So I might, if it's okay, Mark, just push through and wrap that up and then make this available online and share the presentation in a couple of moments' time. So for anyone interested in more details, genetype.com, LinkedIn page here, and our investor relations team, Adrian Macaulay in Market Eye Now Automic Group, can help you answer any of those questions. So what I might do, Mark, is wrap it up there.
Thanks, Simon. Let's just I'm sure that test won't take more than 15 or 20 seconds, so we'll just hold off before we dive into questions here. You can let me know if they're completed. I might just throw out the first question, Simon. In terms of the competitive landscape, can you just sketch out, who are the major competitors? Is there somebody, who's got a similar kind of multifunction test to you that you're competing against, or is it, individual based tests for, whether it be breast cancer or prostate cancer, on an individual level? Or is it the biggest competitors, the kind of screening protocols and procedures that are currently in place?
Hi, Mark. I'm sorry, that test has now been completed, so apologies for the disruption in that presentation there. I think the question was around competitive sets. Was that right?
Yeah. I wanted to know, who do you compete against in terms of, when you're looking for these B2B relationships? Is it with somebody else who's got a similar multifunction test, or individual, people who play in just in the breast cancer space or just in the prostate cancer space? Or is it, doctors just going with current procedure and screening techniques and trying to win them over to, this as part of an expanded screening program?
Yeah, great question. There is, as you can imagine, the market is extremely fragmented. You've got the traditional testing where you would look at something like for breast cancer BRCA, or for colorectal cancer Lynch, and that's a single based a monogenic gene test. You've got a series of companies out there, which is the likes of 23andMe or Ambry or Myriad or Color Genomics, that have some polygenic based risk tests out there for diseases as well. And you have a couple of others out there which are algorithm based as well, which has multiple diseases. So I suppose this one here, in this particular instance for the geneType multi-test, is most comprehensive because it has the greatest breadth of genetic markers, as well as the most comprehensive internally generated clinical risk model, and protected by a number of patents there, versus those competitive sets there, which makes us significantly different. When you look at the consumer genomics, we're also up against things like Ancestry.com, which is a worldwide supplier of ancestry-based products. We have a number of different paternity-based tests out there. So we have family tree DNA. So it's quite a fragmented market out there. So we have to pick our competitors depending on the different tests.
Okay. And the budget impact model that you referred to in the presentation, is there plans to do one of those for each of the tests? That one was in reference to breast cancer. Is there, similar plans to do one for prostate cancer, for example, and then, go back to the insurers again and say, this is now what we've modeled out on that particular disease?
Yeah, that's absolutely. The next one that we're going to plan to do is actually not going to be prostate cancer, but it will be colorectal cancer, for example, because it impacts more of the population. We're seeing that nearly 25% of the population are actually being diagnosed with some form of a rectal-based cancer under the age of 50. Our test can start screening and create proactive patient screening outcomes and identify potentially high-risk patients from the age of 35. So we'll be using that as our next one for the budget impact model, and then take that back to insurers as well. The reason we didn't try and add all of the different tests into the one budget impact model is because it became extremely complex with all of the different populations, the groups, the ages, all of the different screening protocols, and the current standard of care, future standard of care. It became extremely complex. So we focused on demonstration of the impact from a health perspective and an economics perspective on one disease, which everybody was able to understand really quite quickly. So as I said, colorectal cancer will be the next one once we start to get traction with a number of these insurers.
And then just on the screening, do you guys keep the data for, you know, I guess pushing it out into peer-reviewed journals with ever larger data sets, or does that data stay with the patient, or the hospital or insurer or payer in the first instance? I'm trying to get a sense of, you know, how you kind of build on the initial work that was done to get the regulatory approval, but to, you know, really cement its I guess medical credentials by, you know, having these larger and larger data sets of candidates through the test.
Yeah, there's a couple of ways there. So the answer to your first question is we keep the data for research purposes only. And then also if someone or a physician wants to do a test that we bring out down the track, we can actually retest that for that particular patient with that physician. So as I mentioned, there's 3 more tests coming out towards the back end of this year. And we will be able to, without having to do a recollection, just simply get the physician to answer those clinical questions, and then we can report back to that physician that particular information. The overall data is owned by the patient and the physician, and the original basis of which the tests have been developed is based on the UK Biobank database that we based most of our initial testing on as well. So we have a number of other collaborations that we've got around the world, and you will see this in the back of these slides, where we have, for example, Washington State University in the United States with Professor Graham Colditz. We're doing an African-American trial for him at the moment on our brand new breast cancer test, which is coming out soon. So that's on 313 SNPs for our new breast cancer test. And that's going to be really exciting. So those collaborations with broadened ethnicities and things like that are key to the ongoing development of our portfolio, which is that sort of leading edge innovation that we talked about earlier.
And just on EasyDNA, I know the consumer side isn't a major focus, but it is going to be going live, and, you know, people will probably start seeing the marketing as we push into 2023. In terms of price points, where is it going to kind of land in the market for, you know, somebody who's looking at either the ancestry side or general kind of health and wellness side?
There's such an array of tests, so the price points are quite wide and quite varied. So one thing I wanted to say was that EasyDNA and our direct-to-consumer business is an important priority for us to drive growth in the future. It will continue to drive exponential growth for us into the future, and it is a priority, but getting one consumer by market by test is possibly a smaller growth trajectory than getting 1 or 2 key payers where they have maybe 10 million lives covered, 20 million lives covered. And then when you have 50% of that population being female, and then maybe 50% of that population eligible for a breast cancer screening test, the materiality of being able to get those people on board is actually bigger, stronger, and for longer, for example. So both of those channels are really important to us. And they both have slightly different growth trajectories. So EasyDNA, whilst it wasn't talked about as much as part of this presentation today, it's still a really important piece. And it is live today. It is live in 40 countries. It is live. It's the brand refresh and the new e-commerce platform that'll be relaunched over the course of the next month or so.
Okay, perfect. Simon, we're actually just perfectly on time, so I think we'll leave it there, because I do know Steve is standing by up in Sydney for us. So thanks very much for coming back in and giving us an update in GTG, and we'll keep an eye out for updates on payers and all any other announcements that you've kind of highlighted should be coming through in the next 6 to 12 months.
Fantastic. They're all on our website under the investor page. They're all on our LinkedIn page as well. And absolutely love to hear from people. So thanks for having us, Mark. Really appreciate it.
Thanks, Simon. And if I could just ask you, please, to stop sharing your screen. And I'm delighted to be welcoming back another returning presenter, Steve Boland from Acrow. Steve, if you want to start sharing your presentation, I'll let you know when I can see the slides coming through.
Okay.
It's coming up now.
Yep.
I can see the cover slide of your presentation now, Steve.
Terrific, Mark. Thanks. We'll just get all of our technology. There we go. All good. Okay.
Yeah, perfect.
Thanks, Mark, and thanks again for hosting us, mate. It's I think it's possibly a third or fourth presentation through Coffee Microcaps, and yeah, really appreciate the opportunity to talk to investors and potential investors. So we might get cracking through our presentation. Firstly, just I guess under this assumption there'll be some people on the call today that potentially don't know much about the business. So just to give some of the snapshot of the high level stats around the market size of Acrow, etc. So you can see the share price of Acrow has done pretty well compared to the small odds over our life as a public company. Although I will point out today that the business is still trading at not much more than 5.5 times earnings at the moment, despite what you'll see is an incredibly good year last year and also forward forecast. So I continually get told that we're good value, but I'll leave that for others to judge. Revenue heading towards 170 million, up from 80 million when we listed. This business, as an Acrow name, has been around since 1950, but the business in its current structure really has only been in place for about 9 years. Out of Boland into private equity, I came in about 9.5 years ago as CEO, and then took it into a public company land in April 2018. We operate in every state in Australia, and we have 10 depots, 280 people working for us, and 1,300 odd customers. We are basically a formwork and industrial scaffolding business, and we do small scaffolding in some commercial work as well, but primarily focused on civil infrastructure market and the industrial markets. We provide engineered formwork sales and hire solutions. So formwork basically is the equipment that sits under the pouring of wet concrete while the concrete cures. And you'll see, I mean, that sounds quite simple, and it's everything from sort of a slab in a car park to some of the most high level important infrastructure projects in the country, which we've now got a major foothold on basically every one of those major projects. We also provide specialist screen systems, which you'll see some photos later on, I think, in the presentation of that basically that's on a high-rise commercial or residential development. Instead of scaffolding as an edge protection, it's a screen system, which is again more engineered and a better solution. We hire and sell and also provide labour into the industrial sector, primarily in major organisations that are doing shutdowns. For example, right at the moment, we're working on the Visy pulp and paper mill at Tumut. We're providing all of the access equipment and labour for moving that access equipment around to enable their current shutdown that goes for about 8 weeks. And we dry hire scaffold into the commercial sector. Mentioned that we have 10 locations across Australia, so we're in every capital city plus Launceston. We also have two depots in Sydney. We've got 3 in southeast Queensland, 1 in Victoria, 1 in South Australia, 1 in Western Australia, then 1 in Hobart, 1 in Launceston. We've really developed a very strong reputation for ourselves now as the leading provider of this formwork equipment into the civil infrastructure market. We're looking to, that's sort of come out of a very strong Queensland base for us. We're looking to grow that further in New South Wales and Victoria, and there's some really good success in that area for us. And we're looking to aggressively grow our national industrial services footprint, which at the moment is based in New South Wales and Queensland, and we're looking to develop that in South Australia and Western Australia, where the markets are very, we're probably the largest markets in the country. In terms of the Acrow sort of weighing the competitive advantage, one of the main things that we've done over the last 4 years has basically become an engineering company. So that's the way I describe us. If somebody asks what we do today, we are primarily an engineering company for providing solutions for temporary works. We believe we've got the best engineering group in our industry by some distance now, which we've developed over the last 4 to 5 years. So the quality of our people is excellent. We've become, I think, very strong sort of employer of choice in this area. And then we've definitely got the best mix of product range and geographic footprint of anybody in our markets. So there's certainly companies in certain markets that will be bigger than us. For example, we're not the biggest provider of formwork hire and sale equipment in New South Wales at the moment. We're growing that market share quite considerably, but we're certainly by far the biggest in Queensland, more than 60% market share. We're probably the biggest down in Victoria, heading that way in Western Australia. And that comes off the sort of, I guess, the balance between our ability to move gear around the country as different markets are in different situations, and just the range of products that we have compared to our competition. So I mentioned I classify now as very clearly as an engineering company. Between 2018, when we listed, to 2022, we've gone from about 43% of our revenue coming out of what we would classify as engineered systems, which is our formwork and industrial business, to 84%. So we've pivoted the business from being primarily a commercial scaffold business now to, you see, in 22, only 16% of the revenue of the business came out of commercial scaffold. Doubled the number of engineers in the business, 15 to 32. That number actually is now 35 as we go into the new financial year, and we've got a couple of new things that we're doing. And in this space we operate in, where it's an engineered solutions business, price doesn't really become the factor here. It's around providing solutions that will save time on projects due to the quality of the equipment, the backup service our engineering people will provide, safety of the equipment, and I think, focusing in the areas that we do, we're heavily exposed to government-funded civil projects. There is extremely strong civil construction tailwind still for at least the next decade, despite what you may sometimes read in the media. I know what's going on the ground, and I've got some slides to show a bit later on about what I really know is going on the ground. And the sort of the nature of the market at the moment is that projects are being delayed in conclusion, and they're certainly taking longer and costing more. That's not bad news for us. As a hirer of equipment, we start hiring the day a project, gear leaves our yard. We stop hiring when it comes back into the yard. So if there's project delays due to labour, not a problem for us. We don't supply any labour at all in the civil infrastructure space. As I said, pricing is a secondary focus compared to quality, and certainly there's in an area, I think it's well known again, construction can be an area of some concern around bad debt opportunity or bad debt risk and quality of debtors. We've got very small exposure to the commercial area, where there's more risk in that area compared to our civil infrastructure and industrial space. So 22, that seems like a long time ago now. We're only 3 months into 23. Was an absolute watershed year for the business. Record financial results. It was all based off organic growth. We've still got a record pipeline of work in front of us at the moment. The growth was across basically all states and markets, and we go into 23 in pretty rude health. Just want to show a picture of what's happened to the business over the 4 years since we listed. So we listed in April 2018. So you can see over the 4 years, our revenue's gone from 65 million in the first year as a public company to 148. That number will be 170-ish this financial year. So 23% average growth per year in revenue over the 4 years. EBITDA has gone from 13 to 36. We're forecasting at the moment that to be 44, although that's moving on a fairly rapid pace. So, we will probably be putting out additional guidance probably around the time of our AGM in November. So we're 29% up at the moment every year in average EBITDA growth. EPS 57%, so 1.2 cents a share to 7.2. That's now heading into the high 8s and potentially even early 9s in terms of our earnings per share. And as I mentioned earlier, our sales contribution is from engineered services has gone from 50% to 88%. And really importantly, in a business that's growing its revenue as quickly as we are, we're not doing it to the detriment of margin. So margin in 18 it was 20, it was 24.5 in 22. Year to date in 23, it's 29. So we're tracking very well in that direction in terms of our maintaining and improving our margins. The actual results for last year, up 40% in revenue, up 49% in EBITDA. Statutory NPAT tripled. So we've been saying for some time to our shareholders that we were going to be getting scale in terms of NPAT and EPS. We've done a couple of acquisitions 3 and 4 years ago, so it just took a while for I guess our results from terms of depreciation and interest costs off the back of those acquisitions to catch up from an NPAT perspective. And you can see our statutory NPAT went from tripled in last year. Our underlying NPAT doubled. Our EPS nearly doubled. We declared a 1.5 cent per share final dividend, which made 2.7 cents for the year, which is the biggest dividend we've paid. And again, importantly, in a business that's investing a lot in capital and growth, the return on equity had a significant increase between 21 and 22, and that continues again into 23. Last year, some of the key achievements. First one there is, we've got a mix between our industrial services business, where it's a lot of repetitive work and longer term contracts. And then we've got our formwork business, where you do go package to package and contract to contract. And it's really important that you continue to win packages as they become available on the major works. Last year, we secured 50.4 million of new higher revenue contracts, which is the higher revenue really is the profit engine of the business, up 28% year on year. For the first 2 months of this year, in the months of July and August, we're actually up 97% on the same period last year in terms of winning new work. Now, this is probably, well, I know it is. It's a 6-month odd lead indicator, which that gives me the confidence to be able to put out forecasts already, put out guidance forecasts sort of 2 months into the new financial year. I'm not sure many companies are doing that, but we can, because how well we can see the line of sight that we see on our future revenues for at least 6 months off the back of the higher contracts that we secure. The growth all came organically, as I mentioned. Industrial services, we put a lot of effort into growing that business outside of its traditional Queensland base. The revenue in that business doubled last year. The sales contribution went up by 50%. Had a great year in Queensland, which is our key market. They're up 50% in revenue in formwork. We had really good growth in what we call our smaller states. So WA, SA and Tas are smaller states for us compared to New South Wales, Victoria and Queensland, but they all had tremendous years last year that's continuing into next year. And in a year where no doubt companies were challenged by supply chain logistics issues, we took some really significant steps, and I'll just talk about one in particular in the second around timber and ply that we sell into the formwork market. Good results in safety, although zero is your target, so we've still got some work to do to get zero. But we had 4 lost time injuries last year. Clearly, our target is 0. Here's the civil infrastructure spend chart. I don't believe it. I say this on a regular basis. This is a public document, but the peaks in 23 and 24 won't be there. It'll be longer and flatter due to the availability of labour primarily, and that's fine by us. I expect, that's why I'm saying this will be a decade-long, at least, infrastructure sort of tailwind in Australia, and certainly for our business. We're getting strong revenues on all the major projects that you'd expect to see there: Melbourne Metro Rail, Bruce Highway upgrade, Western Distributor in Melbourne, Queensland Cross River Rail, Sydney Metro Rail. I'll talk about a couple of those in a bit more detail. Here's the way our business has tracked in this space over the last 3 years. So the actual market, and mind you, I mean, we're not a big spend at multi-billions of dollars. Our share of that is in the sort of the tens of millions. But our national infrastructure revenue has gone up by 56% over a time, when the actual spend nationally has gone up by 11%. So we're outperforming. You can see in Queensland, we went up by 50% revenue in Queensland between 21 and 22. Victoria, if I go back further to sort of 18 and 19, you'll see Victoria was as low as like 2. We've got significant market share growth in Victoria, holding that position. Had a cracking year in WA, and New South Wales we're underrepresented in New South Wales, but already after the first 2 months of this year and going into September, and knowing what our September result will already be now, I expect the New South Wales formwork revenue to just about double in 23, as we are definitely now gaining market share in New South Wales. Equipment hire revenue pipeline, you can see. So again, reiterating, 28.4% up year on year in terms of jobs secured. Our pipeline is at its highest point ever, at 83.9 million, 14% up on the same period last year. So we're in pretty good shape in terms of both winning work and what's in front of us. In terms of the civil infrastructure formwork quoting versus success rate now, we're batting it better than 50%. So basically 1 in 2 jobs that we quote on, we're winning the job. And I mentioned we're all on big marquee projects. Snowy Hydro is the one that's not a transport project, but is the biggest civil infrastructure project in the country. There won't be a 2026 completion. It might be more like 2030 at the way that thing's going. It's a couple of $1 billion over budget. It's certainly a troubled project, but that's a bit of a so what for us. The thing is starting, it can't stop. It's probably the most important infrastructure project for the energy generation in the country. and 30 million is a very conservative number about how much revenue we will generate from that project. I mentioned others: Metro Tunnel, Bruce Highway, Westgate, Cross River, Sydney Metro, all of the major infrastructure projects in the country. We've got considerable revenues, and yeah, there's still some time to go on those. And there's a range of projects that will replace these as they come to their conclusion. Across our businesses, Formwork, industrial and commercial scaffold, you can see the growth year on year, both in revenue and in contribution. So we're up 30% in revenue in Formwork, up 36% in contribution, up 110% in revenue in industrial, and 53% in contribution. The reason why that was, a lot of that revenue growth was in labour rather than the hire of equipment. We're making around about an 18 to 19% margin on our labour on industrial projects. And that's all on do and charge. We don't do lump sum contracts like a lot of other companies. Ours are all basically, if we're paying somebody $60 an hour, we're charging the customer $72 an hour. And you can see that clearly the business is growing to the degree we have over this year. You know, we've had to grow our structure to support a far bigger business, but we're still getting about 60% pass through from sales contribution margin through to EBITDA, and that certainly is continuing into the new financial year. And you can see that the EBITDA margin overall went from 23 to 24.5, and as I mentioned, after 2 months this year, it's actually sitting at 29 at the moment. The bridge of where the extra sales contribution came from: Formwork hire, industrial scaffold hire, and industrial services labour. Those three areas, which is about $15 million, is where we're spending our capital. So our capital is generating the return, which is what you'd want to see. We already had very heavily utilised equipment, so what we're investing, we're getting very strong returns. I'll show that in a second in a bit more detail. The other one I want to point out here is timber sales. I'll just flick to the next page. So we sell timber and ply to form workers. We've done it basically for the 9 years I've been with Acrow, but it's in the last 12 months that the thing has really taken off for us. So our sales contribution margin in this area grew from 1.3 million in 21 to 4 million in 22, and the margin from 18 to 28%. This came off the back of us being able, well, it's a difficult market at the moment. I think if you follow construction in the country, it's a difficult market. But we've grown our market, our margins considerably, because we found a really good channel of supply out of China. That does come with a working capital impost. It absolutely does. But we're prepared to bite the $5 million of working capital impost off to make a $4 million sales contribution margin on the sale that we make. And we're now doing close enough to $2 million a month of sales in this area from something that used to be sort of $500,000 or $600,000. Capital expenditure, we are in heavy growth phase at the moment. We will be probably for another couple of years yet. So last year we spent 21 million in CapEx. 14 million of that was in growth CapEx. Now we've got a really stringent hurdle rate of 40% return on investment in year one of any CapEx that we spend in growth, and we've done a lot of work on sort of backtracking what that has looked like over the last 2 years, and we're actually achieving an average of 50% on our capital investment for growth, and that's showing clearly in the revenue and the profit growth in the business over this period. We have increased our debt this year off the back of the growth, but we've also got an extremely supportive bank with Westpac, and our headroom available at the end of 22 has increased from 4.5 million to $13.2 million in headroom available through our funding facilities, and that's probably going to go up again shortly. They're incredibly supportive, understand that the business is in growth phase, will be for probably the next couple of years, and really supportive in terms of coming up with creating structures to get us the best results in our funding position. Obviously, successful businesses have good people working for them, and we're no different in that regard. We've done a lot in attracting good talent into the business. You can see some of the recent appointments. These are very high quality people coming into the business, and we're very strong on succession planning. Recently appointed a chief operating officer. The guy's 31 years old, been with the business 10 years, started as a trainee engineer, and now basically the two I see in the business. And some of the other guys in there again are coming through the business. It's a safety first environment. It's all good things you'd want to be valued for. It's a customer driven, solutions focused. Hopefully we look after our employees, or believe we do very well. When we say set industry standards, we actually seek to exceed industry standards and then start to put everybody else on, I guess, a new level. One thing that's not on that list, but it is a fact of the way we run. We're incredibly financially driven, but not to the detriment of safety or our customers or our employees. But we have incredible disciplines around around our profit focus and what we expect. I mean, I do forecasts with branches at the middle of the month and questioning down to hundreds of dollars as to why an expense may be more than it was in the previous month. Short-term, medium-term opportunities. We'll continue to grow industrial services. We definitely were going to pick up market share in New South Wales formwork. We're going to continue to ride the wave with our strong market share in Queensland formwork. We will get more organic growth across those smaller states as we move more product into those states. Western Australia is happening right now. That sort of further WA growth. We are now offering a more integrated engineering service, which means we're actually charging for engineering services that we previously provided for free. So that'll generate us probably $1 million of additional revenue this year by actually charging for services that we previously just threw into the package, and customers are happy to pay for them. And our screens business will continue to grow market share nationally. The big thing for us this year is this jump form product, which is jump forms. If you look at the photos there, this is actually Crown Towers in Sydney. The photo on the sort of the right of that page shows that if you look at the top of the building, that's the jump form coming out of the middle. It's the core of the building. It's where basically the lift shafts and the stairwells, etc., are formed by walls of concrete as the building goes up in floors, and the jump form supports that and goes with it. We've now got a system for the first time. We've run our first 2 projects, starting basically now. $4 million of revenue will make us about 2.5 to 3 million of EBITDA this year. Brand new channel of revenue. It's about a 70% return on investment in capital. We think we can grow this division to $20 million of revenue, probably making 10 to 12 in EBITDA within the next 24 months. So we have provided an outlook at the moment for 23, 165 to 175 in revenue. So usually 15% up in revenue. EBITDA, well, it won't be lower than 44, but we're saying 43 to 44, up 20%. Still further growth in NPAT, and EPS starting to head up towards 9s. As I said, we can do this at this point because I can see at least out now the January or February in terms of what the higher revenue is going to look like in the business, and that's the main driver. We had a lot of capital that we placed orders for last year that only arrived in the last quarter of 22. And then clearly the revenue and profit from the jump form work that we've won, as I mentioned, 4 million of revenue generating 2.5 to 3 in EBITDA. That's an absolute brand new channel. That's fresh EBITDA and fresh revenue compared to what we had last year. So, I'm again very confident in what we're going to be putting forward this year. The business has never been in better health than it is at the moment. So, Mark, I'll throw forward any questions.
Cheers, thanks, Steve. I just wanted to touch on, I know it's been as you touched on in the presentation, a few years since acquisitions were done and they're now completely bedded in, but would it be difficult for you to do future acquisitions given the size of Acrow now from an ACCC standpoint, or is there a few little bolt-on, really specialist engineering guys that would be complementary to the Formwork or engineered services business that you could bring in?
Yeah, we wouldn't buy one of the other major formwork companies, not just for ACCC reasons, but just in terms of compatibility of equipment. Funnily enough, everyone's got their own sort of kit, and it's not all compatible. So we've got our gear, we've got our systems. We continue to focus on product development of our own systems, but we wouldn't be buying one of the other form workers. Certainly in the industrial services space, we're really keen, and we only recently decided not to go ahead with a potential acquisition in that space because the current owners just wanted too much money, really, and they're just a bit unrealistic. So we've parked that one, and it may well come again. But there's definitely the sort of the bolt-on new product opportunities for us. So I think, but really, from the main M&A focus will be industrial services for us. That business we've grown just on the East Coast, and as I said, we're very keen to get into South Australia and Western Australia, and M&A would be the perfect sort of vehicle to do that. And so we did have a company that we're quite keen on, and they are a good company, profitable, well-run owners who are getting to a point where they probably need to move on. There's no sort of family succession plans, but they're just a bit unrealistic at the moment with their return requirement.
Okay, and then I just want to touch on margins for a second. Where do you think is kind of a steady state margin for Acrow if we look forward on a 1, 2, 3 year basis, you know, as the scale, you know, increases, is it that 25 to 30% range? Is that kind of roughly steady state, do you think? And, you know, 30 in a good year, and, you know, 25 in a kind of average year?
Mark, it completely depends on the mix of the revenue. So just to put some guidance there, we've got 3 streams of revenue. We've got hire, we've got the provision of labour on industrial, and we've got the sale of equipment. So hire is 100% pass through in terms of the margin. It is 100% pass through. Our labour makes about 18 to 19%, and our sale of equipment averages somewhere in the 30s. So if we've got as we've had in these last couple of months, our revenue in July and August was very heavily slanted towards hire. And so in those months, we've got, as I said, we're pushing towards 30% margin. We have another month where we do some really big sales that we make maybe low 20s on the sale. And we've got a few of those coming up. We know that there's already a few coming up in the next 3 months. And that will reduce the margin in those months to the low 20s. So it totally depends on the mix of revenue. But you know, but that's why at the moment, to be honest, I've got more confidence about my EBITDA guidance than I have on my revenue, because I haven't factored in any really big sales into the revenue or the EBITDA. I know they're going to come at some point. So we've just picked up a couple of $1 million worth of quite large sales in the last 3 weeks that came out of sort of nowhere. But I'm basing our EBITDA forecast on what I know is there in higher revenue. That's absolutely transparent now. I can see at least 6 months out.
And then, yeah, if we just talk about the bigger projects, I know you're saying you don't believe that graph. It's going to, and we all know Snowy Hydro is well over budget and going to run longer. And given where the world is now in the last 6 or 8 months on energy security, I definitely don't think it's going to be stopped. But in terms of these big projects that are going to come to an end in the next, let's call it, you know, 3 years or so, I'm thinking, you know, like Crossrail, Sydney Rail, those ones. What's some kind of marquee projects that either the, you know, state governments or federal government are talking about but haven't quite pushed the go button on, or tenders haven't been issued yet, that, you know, you're eyeing up, that you know is going to, okay, it might be 6 months from now or a year from now, but, you know, these are going to go live at some point? What are the ones, you know, people, once we see that going live, that we know Acrow are going to be actively tendering on?
Yeah, so there's quite a lot of projects that the button has been pushed on, but they won't start for the next 6 to 12 months. So in Victoria, for example, so the 2 major projects that we're getting in civil infrastructure getting significant revenue are the Metro Rail and the Westgate Freeway and Tunnel. So the Westgate Freeway and Tunnel will come to conclusion in about 2 years, and it's going to be passed. It's going to be, you know, it will be surpassed in terms of size of project by the North East Link motorway in Melbourne. That's going to start in the next 6 months to 12 months. And then there is an underground rail system going into the eastern suburbs of Victoria, similar to New South Wales. So the Sydney Metro Rail, as it stands at the moment, which goes from sort of Marrickville to Chatswood, is basically almost probably 12 months from conclusion. But now contracts are being let for the Inner West Rail and the Outer West Rail. So these things will just kick in. One of the big projects at the moment, when you're looking at Acrow in 12 months' time, that you'll see a lot of revenue, and we're talking a lot about Sydney Gateway. So Sydney Gateway is the motorway development that takes us to the international and domestic airports. I don't know if anybody's been to the Sydney domestic airport recently, but you'll see a hell of a lot of work going on in terms of overpasses and bridges going into the domestic airport. All the formwork equipment on those projects is ours. We just won a $1.2 million package on that project about 3 weeks ago. So there is certainly, and then going to Queensland, the big one in Queensland will be the inland rail. So the whole inland rail that basically runs through almost the Great Dividing Range. So that project, again, tenders are being let, packages are coming out. So I'm not, again, I can almost see like for like replacements for all of the major projects that are there at the moment that are coming to conclusion in the next 2 years, certainly in those 3 states, with new projects that will be kicking in.
Okay, great. I think we've got time. Yeah, let's try and get in one more question if I can. On the Formwork timber, is there other little revenue lines within Acrow that you think can potentially like grow out like the Formwork timber, as you say, it went from, you know, the 500,000-600,000, you know, up to the 4 million mark, I think it was on the slide. Is there a few other little kind of hidden gems within Acrow that you think if we put a bit of focus on this and put a bit of capital towards it, it can be a nice kicker to the bottom line and the overall result.
We think we can do more in timber still. So there's certainly, we could probably double the timber business if we can get the right arrangement, sort of working capital arrangement, because we've got to pay for that stuff basically up front, and then there's about a 4 to 5 month working capital lag, right? So that's one thing that we know, and we're talking to our bank at the moment, and they're quite very supportive. We could probably double the revenue in that and profit in that business if we're prepared to sort of suck up the working capital impost that would have on us. The other sleeper, and you'll see it if you watch our results this year compared to last year. We're getting margin growth on our small commercial scaffolding business for the first time in about 8 years. Our rates are going up. Now that business is a supply and demand market. We're not going to put any capital into it, but in terms of just growth, there is not enough gear in that market at the moment, and rates are going up. So you'll definitely see improvement in that part of the business this year for us. But look, I'd say, look, the timber, and then in terms of our hire equipment, Mark, it's that jump form business. Once we get these first 2 contracts out of the way, and make sure we've got the system 100% right, and we're providing the service the customer wants, we're going to be talking in November, December at a board level about significant upgraded investment into that, and that we won't have trouble finding jobs for that business. It's really going to be up to us in terms of execution. The market is there. We're being asked to join markets. We're being asked to quote on jobs all the time. As I said, that's going to be, I've got no doubt within a couple of years, you'll see $20 million of revenue coming out of that business and 10 or 12 of EBITDA from nothing last year, and this year probably, 4 and 2.5 to 3.
Okay. We will leave it there, Steve. Thanks very much again for joining us. And yeah, this is, if you include the in-person presentation, the 4th time you've come back to give us an update at Coffee Microcaps. So thanks very much for your support and coming back in on a regular basis to keep us updated.
Thanks, Mark. Good on you, mate. I'll do the stop share thing now. And
yeah,
there you go.
Great. And I can see Scott is waiting for us there patiently. Scott, if you want to start sharing your screen, I might just turn off the...
Absolutely.
I'm just going to stop the video there, Scott, just so we get the clear... Oh, what's going on there? Here we go. Yeah, I can see the cover slide of your presentation now, Scott.
Tremendous.
So ready to go when you are.
Oh, okay. Wonderful. Thank you for the opportunity. G'day, everybody. Scott Basham from Xtek, and it's my great pleasure to be able to give you an update on what we've been doing over the last little period and what our future is looking like right now. Just by way of quick example and explanation, so Xtek is an Australian-listed defence industry company. We operate as 2 distinct divisions. Our ballistics division, which is based on our global armour business called HighCom Armour, is very much focused on designing, manufacturing and building world-class advanced personal ballistic protection products. And that includes body armour solutions, ballistic helmets and composite arm structures. And then our technology division is focused very much on manufacturing and supplying defence and security agencies here in Australia with world-leading Australian-made and globally sourced, exclusively sourced systems, sensors, software and support. So if we just drill into each of these 2 divisions a little bit, HighCom Armour has 2 production facilities around the world, and you need to think of HighCom as a portfolio manufacturer. We have our value products, our commodity products in inverted commas, high quality but price sensitive products manufactured out of our Columbus, Ohio facility. And then we have our high performance, ultra lightweight, high performing ballistic protection products manufactured here in Australia in our facility in Adelaide. Xtek has owned the HighCom Armour US business for just over 3 years. 2 of those years, of course, have been as part of the pandemic. And then our Adelaide manufacturing facility has been in production now, low rate production, because it's a bit like Ferraris, as I like to say, for just over a year now as well. So we take our armour, our price driven and high performance products to all parts of the world. Our US facility had been very focused in days gone by on manufacturing for private label manufacturing, in fact. So that business typically turned over about $10 million a year, sort of 15, 16, 17 Aussie dollars year in, year out. But about 70 or 80% of the product in days gone by had been going out the door with somebody else's sticker on it, who would then sell it under their own brand through their own distribution network. So really a bit like, you know, selling bumper bars to Holden, as I like to say. Our name wasn't front and centre on 80% of the stuff that went out the door from that facility. Some 20%, the remaining 20% typically was split, half of that through a badged channel distribution network that we have. And then the other 10% was typically direct sales or as a result of some panel arrangements that we had at the state and federal level throughout the US. The Adelaide manufacturing facility, if I can give you a quick example, has unique patented technology, worldwide patents for Xtek on the way that we make our ballistic armour. We have a machine called the XT clave, which, if I can give you a quick layman's description, is a great big cigar tube pressure vessel that's 3 meters long and 2 foot wide. And inside you have a bit of a dish rack like you might have on your sink at home. And we stack the body armour plates inside that and helmets inside that. Then we fill that full of hot oil. We take that temperature up to 200 degrees Celsius, which helps melt the glues that are embedded in the fibers of the Kevlar and carbon fiber and polyethylene type materials that we use. And then we apply pressure, 300 bar of pressure. Now, I don't know if you're a paddy diver or anything like that, but 1 bar is the same amount of pressure as 1 atmosphere, which is 10 meters of pressure when you're diving on the barrier reef. So it's the same as 300 atmospheres or 3,000 meters of pressure. And I like to say that's submarine hull crushing depth, because what that allows us to do is to put that those Kevlar and carbon fiber materials in the hot oil and melt and then squeeze them basically into a form or a shape or a tool. I like to say a cake tin sort of thing that's got the curves and the intricacies of the complex geometries tooled into it. And then we can create these high performance and ballistically fantastic products. One of the things you may not know about helmets and body armor is that they're rated to a certain level of protection. So basically on what type of bullet that they will stop. Body armor plates, the plates that we make, stop basically all types of rifle bullets. But what you may not be aware of is that the helmets that you see on the news every night of people wearing, you know, soldiers and SWAT teams and all the rest of it, those helmets only stop pistol rounds. So 9mm, 357, 44 Magnum, and then some fragmentation from grenades or perhaps artillery rounds and things like that. The helmets that we can make in our fantastic patented technology, the XT clave in Adelaide, are rifle rated. That means that we can stop AK-47 bullets and other big rifle bullets at point blank range. And that's really important to understand. AK-47s at point blank range. And so the technology that we have and that we're now in manufacturing and in production in Adelaide is unique next-gen technology that we're taking to the world. And there are great opportunities for us, as I talk about our pipeline of opportunities in a moment, for all of that. And I'll come back to that in a moment. Our technology vision is really the legacy of what the Xtek business used to be in days gone by. I've only been with the business for 18 months. I joined in February last year. I came on board actually to initially run the technology division. And then on the back of a strategic review that was undertaken by the board, I was asked to become the Chief Executive Officer for the group. And so through the first half of last year, we implemented a lot of change and restructuring and refocusing the business onto, you know, the 2 divisions and our customers. So this part of the business is, as I said, the legacy agency business, but very much skinny down and focused on the UAVs and the UGVs, the drones and the robots, the things that go on them, the detection and optical sensors, and then some unique software that we make here in Canberra, as well as the support and integration and training and maintenance and the like. And this part of the business is a fantastic business. It's got some pent-up demand that we're expecting to see come through in new orders in the coming weeks and through into next year, which will be great for this year and backlog for next year. And it's a great little business. It's a profitable little business. And some people ask me, well, why don't you just get rid of that? If all the growth and everything is coming out of your armour business, why don't you just cut this sort of agency business away? And that's a fair comment. Absolutely, that's a fair comment. But what I like to say to that is actually that because we're an Australian defence industry business and we have contracts with the Australian Defence Force, we get to talk to everybody inside the tent on a daily basis. We get to talk to the procurement folks and the support folks and the acquisition folks and the capability folks, majors, colonels, generals, and the like, day in, day out. And that's really important. There are many other technology companies out there that have got great products and they want to sell to defence, but they don't get the opportunity to talk to the key people. We can do that every day of the week. And so, that intangible value of the access that we have through the long relationships that we've created is really important. And as we grow the products that we want to bring in, like our advanced technology systems and solutions, then, it's really important to be able to access these people. And that's probably a nice little segue for us to talk about our board. So at the back end of February, we had some refresh on our board as well, following on from the restructuring of the business, the management team and all the rest of it in the first half. And so we have a new chairman, Mark Stevens, who's a very highly regarded defence industry expert, professional advisor. He's consulted by many Australian defence industry companies and defence itself. And so we're very fortunate to have Mark and his expertise here. He's a former infantry officer from many years ago and was the same class as the current chief of the Defence Force. So, it's great to have that level of connectedness as well. You'll see Christopher Pine's name on the board. Christopher, former Defence Minister and Defence Industry Minister. He's got great government relations and political access for us, and that's been very useful already in the last calendar year on some of the things that we've been doing around the place. And then Mark Smethurst, a former one-star Brigadier Special Forces Army officer. And Mark is very well connected, not just into the Australian Special Operations community, which are the user group for all the fantastic product that we make, but he's also a global ambassador for the Global Special Operations Foundation. And that gives us access and connectedness to special operators all around the world, in the US, which is a huge market. And beyond that. And then on the other side of the corporate boardroom table, we have Chris Fullerton, Ben Harrison, and more latterly Adelaide McDonald, who have this finance expertise, capital markets expertise, which is really important for our plans for future growth, corporate activity, and the like. And you might have seen that we just put out a capital management policy, and they all had very much to do with that. And so you may have also seen just on that slide previously, we had at the end of 30 June some residual borrowings. We've subsequently paid that out, and we made that mention in our capital markets announcement a little while ago. What did we do last year? Well, we had a cracking year last year, but it was on the back of a lot of heavy lifting, a lot of hard work to get the business into the right shape. And I really stress that to the folks that I've been talking to recently about our full year results. We really refocused the business. We right-sized the business. We got rid of a lot of waste, inefficiency, excess, and underperformance. And that got us into fighting shape, as I like to say, to be able to capitalise on the opportunities that have come to hand. We more than doubled our revenue, and we increased our gross margins significantly, primarily on the back of being able to change the way that we go to market with our sales. And so previously, as I said, the Hycom business was a private label manufacturer. 70–80% of what it pushed out the door was sold to a handful of OEMs at 50 or 60% off retail pricing, and that was a great mature business, and it was solid business and run rate business. Typically made, $1 million US on 10 million of turnover. So a great little business, but it was never reaching for the stars. And because we've then been able to sell direct, and all our growth in the HighCom business has come very much out of the international sales that have been generated in Europe, but also in the Asia Pacific, as you look at our announcements over the last few months. And that's as a result of the new sales folks we've brought on and the new management team that we've put across the business. You can see we're a turnaround. We are a massive turnaround business, and we are tremendously well placed now to leverage that further into 23 and 24 and beyond. And I'm really proud of the hard work that has gone into setting us up for this position. We've got a pipeline of opportunities at the moment, 130 million, 30 million of that are for our technology business. We're expecting, there are contracts being negotiated right now on those opportunities, and we're expecting to make announcements about that over the coming weeks for part of it, and then into next year, and that will then build into 24 backlog as we go forward. And then the other 100 million of opportunities there is on our armour business, and that is, of course, related to Eastern Europe, but only about 60% of that 100 million, and it's not all focused on Ukraine specifically. There is a huge amount of rearming and upgrading of capabilities that's going on in Europe. Poland is increasing its army from 150,000 soldiers to more than 400,000 soldiers, 250,000 extra men. Finland is looking to create a national reserve, a bit like what Switzerland do, as I understand it, of 900,000 people. And we're a current incumbent supplier to Finland, as some of you may recall. And so that'll be the case, that everybody has, from 16 to 60, has a rifle and a set of body armour and a helmet in their cupboard, and they wait for the balloon to go up or the signal to come over the TV or whatever it happens, as we've all seen in movies. So that's quite amazing. The Baltics, Latvia, Lithuania, Estonia, Hungary, Romania, Germany, they're all waking up that just because they buy gas from Russia doesn't mean that they're friends. And so there's a unique opportunity there, and I'll talk about our expansion plans here in a moment. I'm not going to talk too much to this slide deck, other than to say that you can see from the year on years here the significant change in the business performance. And I just note that thing about the sustainable higher gross margins because of the change to the revenue mix. I think this is a really important little slide. It shows sort of the year on year of our technology business. I mentioned that there's latent and pent up demand. Obviously, the Australian Defence Force didn't buy a lot of stuff through the middle of COVID because everybody was work from home, and it's a bit hard to do some of that stuff when you're doing that. But I would have expectations that those numbers will, double, and perhaps a bit better than that for the technology division year on year. And then you can see that the massive change in being a $10 million private label manufacturer to actually a company that's got a sales force and that's working its channels, and then it's selling direct to customers or through channel partners, and only discounting off recommended retail slightly compared to significantly as we've done in the past. And my expectation is, you saw the number there, 58 million turnover. We had 45 million in backlog at 30 June, which included 2/3 of the $33 million deal that we didn't recognise in 2022. And we've just got the last batch of that about to go out soon. So you'll see an announcement confirming that, updating the market on the completion of that order. And we are in a unique position with those customers about the level of satisfaction that they have had on us delivering those 30,000 sets of body armour and helmets, which, if you put it into context, is the same size as the Australian Army. And we did that in 113 days, 278 tonnes. and just 400 pallets on 17 flights and all the rest of it. Just an amazing performance. So in 3.5 months, we re-equipped the equivalent of the Australian Army, and that's really important for the military customers that we're talking to, because they want to know that you can supply at volume and in a speedy way, and that you deliver what you say. And so our teams have been working tremendously hard. I'm really proud of them, and we're now building to backlog because we have very strong expectations of follow-on orders from Europe and more orders coming through our pipeline in the Asia Pacific as well. I think this is an important thing. I think everybody's very aware of what's happening in the world, Ukraine, all the rearming and carrying and refurbishment of capability, but then more closer to home for us, all the stuff that's happening with China over Taiwan, and then the influence they're trying to exert in the South China Sea and the Asia Pacific more broadly. There's huge money being spent on defence in Australia, of course, but in Japan, in Singapore, in Thailand, in the Philippines, on and on and on. And first and foremost, as a former Army officer myself, my 30-year graduation reunion at the end of this year. So my classmates are now the 1-stars and 2-stars that are in the business, running the business of defence. First and foremost, the first thing they teach you to do when you become a soldier or a sailor or an airman is to fire a rifle, right? You're all an infantryman when it's all said and done, and an infantryman needs a helmet and body armour before they do anything else. I think that's really important, actually, just for me to touch on from an ESG perspective. Once upon a time, Xtek used to do sniper rifles and other lethal goods. We don't touch any of that stuff now. We are far clear of all of that. We are all about life-saving ballistic body armour, and then reconnaissance and surveillance technologies that you see every day on the news. So that's really important for folks to have that understanding about where we're focused. Very cognizant of time now, but just to hit a couple of key things here. Our sort of high-level strategy. We're spending money to reinforce success. We've spent money to get additional manufacturing capability so that we can continue to ramp production and have uninterrupted production. So that's been very important for us. Seeking adjacencies, finding those areas where we can execute quickly and that we can deliver new opportunities, new revenues into the business. That's quite important. And then creating our future is all about the fantastic next generation product that we make in our patented facility in Adelaide. And then the bottom dot point here is really our focus on growth. As I said, we've just put a capital management strategy out recently, and that outlines our intentions about the use of funds and the priority of that use of funds. But we're actively growing organically. We're looking at a warehousing capability in Poland. We're recruiting sales staff in Poland and operational staff, multilingual folks to be there and next to our key customers. But then we're also looking for inorganic opportunities. There are opportunities for consolidation of players in the US and in Europe. And we have great technology that's in high demand, and there are competitors that we have that make those only pistol protected level helmets that can see an opportunity with us to bring our technology. So I think there's a lot of great potential in that. And certainly the US military are looking at a major contract. You can look it up, the Integrated Head Advanced Protection System, RFT, 406,000 rifle rated helmets over 5 years. So lots of great things that we're very focused on. And if I'm summarising, again, cognizant of time, we ended the year with cash at bank. We have orders in hand to make sure that we far exceed the number that we just hit. We've got a great pipeline of opportunities that are very exciting and I'm very confident about. And they're not all just focused on the Ukraine area specifically, but spread across both divisions and through the course of this year, building backlog for 24. We've got a great management team. We've got a refreshed and very professional board. and we're uniquely positioned to take on 23 and beyond. And that's it. So I'm happy to take questions if that's what we're up to.
Thanks, Scott. Yeah, just a couple of questions. One of them just on margins. I know you had a big jump up in margin, partly probably because of increased volumes and the more sales of HiCom versus private label. But what should we kind of think about in terms of like steady state margins? I appreciate now it might be a bit of down to revenue mix between technology and the statistics thing, where the split lands for on a full year basis. But it was 18 bips up to 47. Should we be thinking, in the mid 50s on a kind of steady state basis going forward, or?
Yeah, so that's a great question. And look, I will always look to under promise and over deliver. So, you're very right that the 47% gross margin is a blended number, and it is impacted by, the more contribution the technology division has, but at, a 20% gross margin is going to impact that over time. And so, while we're happy for the top line number, of course, we want our gross margin to improve. We did deals in the armor business that was 60% gross margin on some, 50% on others, 40, 35% on others still. So again, that's a blended number for that division as well. Look, if we could be in and around what we're doing right now, I would be very happy. I'm incentivized for top line growth, for net margin improvement, for EBITDA and all of those things in my incentive plan. So the board is very clear, and the folks there who give me these targets are very clear about where we should be. But as I say, if we can be in a comparable position, I would be happy, and I have expectation that we can work hard to improve that. I think it should also be mentioned, and I'm sorry I didn't say it, but in the technology division, we are actually somewhat contained by defence on what margin we can add to the hardware of the international sales. So again, they look at our books and they give us a procurement guideline about 15 to sort of 17.5% gross margin add-on to the hardware side, but then we do 66% on the support side. And a defence contract is typically a 50-50 split on the acquisition piece of the hardware, and then the multi-year support contract going forward. And both typically, if it was a $40 million deal, 20 million would be the hardware, and 20 million over 5 or 10 years or whatever it might be would be the support contract. So it does come down to, as you quite rightly said, what's the blend of revenue that's coming in, and those particular line items therein.
And then I just wanted to touch on the Xtek machine in Adelaide, because I remember when we've had Xtek in the past, there was quite a few questions or concerns maybe around capacity and when a second machine would need to be built and probably installed in the US, or maybe now these days that might make more sense to have it in Europe, because I know it's a big capex expense from memory. So in terms of, if some of these 30,000 unit orders come in quick succession from various countries, the capacity to actually, I guess, produce those in some kind of timely fashion.
Yep. So great that you've got a long memory, because that's really important to give context to what I'm about to say. So certainly, as I took over the business a little over 12 months ago now, one of my key things was to make sure that we sweated the assets we had before we spent more money building other things without orders to drive production. So I've been very focused on that, and the new management that we've put in to the business in Adelaide on the back of the restructuring change and all the rest of it have got very great clarity on what our capacity is and the potential is and all the rest of it. Adelaide is never going to make hundreds of thousands of items, full stop. It is Ferraris, it is Lamborghinis, it is high performance, high value product. And so, there's a level of effort that goes into that. We are increasing yield in the machine. So I think I mentioned the fact that it's got a dish rack like you put your dishes in on the side of your sink at home. We have designs to be able to increase the number of slots in that dish rack to put more product in to increase yield for plates and for helmets. And so that's certainly a help to take out some of those production cost of goods considerations as we look at that. Second machines, absolutely. And 12 months ago, 18 months ago, 2 years ago, whenever it was that you had those conversations about future machines, were probably premature because the market's not ready. I mentioned that US DoD opportunity. That's the sort of driver that would have us considering the build of a machine in the US or elsewhere. And certainly, as we look for inorganic growth opportunities, maybe with helmet manufacturers or others in the US that have existing contracts, so they have that supply history credential to the US DoD, and then say, hey, look what else we've got now. That's the way in. The HighCom business has never had under its own steam US defence contracts. I'm sure that some of the resellers of our product who put their sticker on it are sold to the US defence. That's why we're increasing our defence sales team, and that's why we're looking at these potential acquisitions of US companies that have defence contracts. So that's very much in the mix. But again, it's a prudent and conservative approach. We need to sweat the asset and get a return on the investment that's already been made. And as shareholders will know, over multiple years, some $10 million of investment has been made in the facility, not just specifically the machine, but in the entire facility we have in Adelaide. And that's what we're looking to get a return on right now. And that's why it's so exciting when I say that there are great opportunities for this business going forward. Now, it's not all going to happen tomorrow, and it may not happen next week, but the world is turning now as they move their old war stocks of these pistol level protection helmets in particular and other things into Ukraine. They all go, right, now we need to replenish our own stuff. Let's not buy more of the other stuff we had. Let's buy the next gen stuff. And that's the opportunity for Xtek.
Yeah, thanks, Katja. And I do remember the US business previously had very good relationships, I think, with police departments, whether that be on a state level or a city level. But yeah, I don't recall having major defence relationships, but I had a very good network in the police front line.
100%.
And then just one quick last, in terms of acquisitions, would it be similar to the US acquisition where it's more on a distribution basis, if we're say looking at Europe, where they have their own existing product, whether it's white labeled or their own, but it just gives you that market access, kind of like when you refer to the technology division, you're talking inside the tent on a daily basis, where it gets you into the market with the right context, where you can really push the HighCom product alongside the other product, but you can adjust the focus to that business to push HighCom product more so than a white label offering that they have, or maybe indeed their own product.
Well, I think you've been reading my diary. It's exactly that sort of approach. We're very aware that the acquisitions we make need to be accretive, and they need to be additive to our existing market share and capabilities. So in the US, we're very much looking for competitors or players who have defence contracts, so that we can bring our high performance body armor and helmets through them into there, but also leverage the connections and the product that they make already and the distribution networks that they have. And similarly in Europe, we're looking for a launch pad first of all, and so we'll have a branch office there as a starting point. We'll look at 1,000 square meter warehouse. We'll recruit some local staff, but we're absolutely looking at potential opportunities in Europe. There are a number of small and medium sized players in there that would benefit from the technology we can bring and then the potential, in the fullness of time and all other things being equal, to have a plant, an Adelaide-style plant in that territory, manufacturing for the local market to supply this world-leading next-gen technology.
Scott, we've gone slightly over time, and I want to thank you very much for coming back in and sticking with us there for those last few minutes. And yeah, we'll keep an eye out for updates, and hopefully we can get you back in maybe early next year to give us a further update.
Wonderful. Thank you for the opportunity.
Thanks, Scott. And with that, I'll wrap up this morning's meeting and wish everybody a good rest of their Wednesday.